Hello and welcome back to the channel. Today we will be discussing about specified domestic transactions under transfer pricing. Transactions between related parties have long been suspected of being used to shift income and thereby decrease a company's or group's overall tax burden when operating from numerous places with varied tax regulations. Even before the idea of specified domestic transaction was incorporated into Indian tax legislation, there were various additional regulations in place to prevent tax evasion through intercompany transactions between domestic companies in the same group. The idea of specified domestic transactions was added in the Income Tax Act of 1961 by Finance Act of 2012 in order to prevent tax arbitrage opportunities in transactions between domestic enterprises. The question that arises is, what was the need of introducing specified domestic transactions? Transactions between two different enterprises belonging to the same group of companies in the same tax jurisdiction have no effect on the authority's revenue base. For example, Company A and Company B are both situated in the same tax jurisdiction. If Company A claims more than fair market value for the goods or services it provides to Company B, the drop in Company B's income is offset by an equivalent rise in Company A's income. On the other side, when Company A undercharges for goods and services, the income of Company B increases by the same amount. From the perspective of tax authorities, it receives the same amount of tax regardless of who pays the tax. This is known as revenue neutrality, and it occurs when intergroup transactions have no impact from the perspective of tax authorities. But the tax implications change if one of the parties to the transaction is either losing money or is required to pay taxes at a reduced rate. Profits can be purposefully moved to such entities in such instances to decrease the company or company's overall tax burden. Assume Company A and Company B are part of the same group or are significantly controlled by the same set of shareholders. Company B, on the other hand, is an eligible unit that qualifies for tax breaks under the income tax legislation. In such a circumstance, when delivering services to Company B, Company A can undercharge for such services, cutting its profits while raising Company B's income by the same amount. However, because Company B is on a tax break, such gains are exempt from taxation. As a result, the overall tax paid by the group is lowered. This is known as tax arbitrage. The goal of introducing transfer pricing provisions to specified domestic transactions is to reduce tax arbitrage and ensure the tax authority's revenue base is not impacted by such unfair practices. So what is the definition of specified domestic transaction? According to the Act's provisions, once a transaction is classified as a specified domestic transaction, all the regulatory requirements such as transfer pricing documents, the accountant's reports and so on apply to it in the same way as they do in international transactions. The term of specified domestic transactions was added to the Income Tax Act of 1961 by the Finance Act of 2012 to make some transactions between domestic corporations to be treated as specified domestic transactions and to make them subject to domestic transfer pricing restrictions. The following conditions must be met in order for a transaction to be classified as a specified domestic transaction. The transaction should not be multinational in nature. The transaction should fall under one of the parts 2 to 6 of section 92BA. The total amount of such transactions entered into by the SSE should surpass INR 20 crores with effect from assessment year 2016 to 2017. Now let us discuss the interpretation of specified domestic transaction. In other words, in order to be considered a specified domestic transaction, in other words, to be captured by the description of specified domestic transaction, the overall value of specified transactions under the varied provisions of section 92BA must exceed INR 20 crores with effect from assessment year 2016 to 2017. The mentioned threshold helps to ensure that any taxpayers with few transactions with the related entities are not burdened by the transfer pricing compliance requirements. The mentioned threshold helps to ensure that any taxpayers with few transactions with related entities are not burdened by transfer pricing compliance requirements. This threshold limit also ensures that the cost of compliance and administrative burden associated with such provisions does not outweigh the benefit derived from them. For more such content, please like, share and subscribe to the channel. Thank you.